Yo, what's going on, everyone? Welcome back to another video. Smart money concepts is constantly moving. It's improving, and there's new concepts that are being added day by day, week by week, month by month. It could get extremely confusing, especially if you don't know the basics, let alone the new concepts that are being involved, such as smart money traps, such as liquidity grabs, and such as the wicks and the volume profiles. So where do you start? What do you do? How do you move? How do you start? It's very simple. My philosophy is you start from the basics and then move to the advanced. And that's exactly what this video is going to be on. This video is going to be a full in-depth breakdown of the smart money concepts. So I'm going to give a brief explanation of what smart money concepts is, how you could use smart money concepts, and what are the concepts within smart money that we use to trade the Forex markets. So let's become familiar with the terms first. I'm sure a lot of you guys have heard the iconic CHOC, BOS, LQ, COS. COS isn't used as much. I think I'm like one of the only ones who use the word COS. COS, and we also have Wyckoff. I'd say these. So what are these terms and what do they mean? So the first thing, CHOC, it means change of character. Change of character. Here we go. A change of character is quite exactly what you imagined it to be. CHANG, yeah. It's basically when the market changes its character. There's a certain character of the market, right? And the character, let's assume that these characters are the characteristics of the market. Trend at the moment is it's in a downtrend. And then simultaneously, there's a quick reversal to the upside. That is considered a change of character because that is not a part of the downtrend character, right? And now we have a new characteristic, which is a bullish characteristic. So this is called a change of character. Now a BOS. The BOS and change of character are the exact same things, at least from my perspective. A break of structure, that's what the BOS means, is basically whenever the market just breaks structure. So for those basic beginners that are out there who are starting from scratch, structure are important lows and important highs of a trend. So we have higher highs, higher lows, lower highs. Very simple, right? Now, each and every single lower high is a structural point. And if price action surpasses either one of these levels, they're labeled and considered as breaks of structure. So the BOS simply means breaks of structure. What does LQ mean? Now, this is the topic that a lot of people get confused on, so I'm going to try my very hardest to make this simple and comprehensible. LQ is also known as liquidity. Now, there's two definitions of liquidity. There's like the business definition of liquidity, like when you go to a bank and you're not even a bank. Let's say you go to a apartment and you're looking to buy the apartment. You go to a real estate and you're looking to buy real estate. And they ask you, okay, how liquid are you? How do you want to pay for this? What they're essentially asking you is, how much money do you have? That's essentially what they're asking you. Now, the liquidity in the Forex market, it's a little bit different, but pretty similar. Same bracket. They fall into the same bracket. Liquidity equals money. So I'm sure a lot of you know what a stop loss is, right? When you enter a trade, you obviously set your take profit. Not all the time, but preferably you want to set your take profit. And you also want to have your stop loss ready. Your stop loss is going to be the tool that limits you from taking more losses than you want. So essentially, if I'm only willing to risk $15, that's the amount I'm comfortable risking, then my stop loss is going to limit my loss to only $15. Now that $15 is liquidity. That's $15 of liquidity. That's literally what liquidity is. Liquidity is just money. That's it. Now we're going to get into the in-depth of how we can use liquidity to trade it and etc. But all liquidity is, it's literally just money. That's it. For now, the basic understanding is liquidity is money. Now, what is a continuation of structure? Or a COS? I just gave it away. So a COS is a continuation of structure. I spelled that totally wrong. Continuation of structure. There we go. A continuation of structure. This is the opposite of a CHOC and a BOS. So a continuation of structure is when the market is following a specific character. All right. So let's assume the character we're following today is a bullish character. Each high that's taken out, right? Remember, each and every single high that's taken out is considered a continuation of structure because we're continuing the trend. So the definition of a higher high and higher low trend is that the market is going to create higher highs higher than the previous high. So this is why the name, or this is where the origin or of the word continuation comes from. It comes from the point that the trend is continuing the structure, right? Versus a break of structure would be like this, where the market is following a specific pattern, and then we have the opposite, right? Instead of following this higher high, higher low, the market breaks a higher low and creates a lower low. So we created a high and then we created a low that's lower than the previous low, instead of a low that's higher than the previous low. So as you can see, we have a low right here, and then we have a second low. So this low is higher than this low, right? And then we have another low. We have this low right here, right? And this low is above this low, except that now that the market has created a low that's lower than the previous low. And this is what a break of structure is, a BOS, or you could also call it a change of character. And the continuation of structure, it would just be like this. We have a high, continuation of structure. High, continuation of structure, right? It's because the market is breaking above previous highs that are higher than the previous high. So there we go. And then we have the final word, Wyckoff, which is just another concept used for advanced market structure. There we go. Oh, structure. Spell that right? Structure. I'm typing really far away from my keyboard, so bear with me. But yeah, Wyckoff is just another term for advanced market structure. So essentially, you know when you go to the chart, right, and you see all this, you know, there's all this mayhem, all this craziness going on, right? Essentially in Wyckoff, all this mayhem or craziness, whatever you want to call it, they have specific identities. Each part of the market has a specific phase, and they have terms inside of those phases. Meaning that, for example, just to make it very simple and comprehensible, imagine this line is phase 1, and we're going to call phase 1 the uptrend. And then imagine phase 2 is from this line to this line, and this is the downtrend. And then phase 3, the final phase, is the $1 million entry. Let's just make a joke, like $1 million entry, something like that. Nah, that's confusing. Let's call it the reversal. Let's call it the reversal. Now, inside of these phases, we have specific terms like PS, right? BC, ST, UT. And don't worry, I completely know how confusing it could be in the moment. When I was trying to learn this at first, it was really hard, but I have a way to simplify this and understand this in a very comprehensible, coherent way. So bear with me. So now that we're familiar with the terms of smart money concepts, right? These are the main five terms that you're going to be hearing a lot. So what's next? The next thing is to differentiate from smart money concepts and retail concepts. So what is retail trading and what is smart money trading? Retail trading, someone could actually make the argument that smart money trading is another type of retail trading, and they're not wrong, it is, right? But the difference is, so we must understand the personality behind the moves of the market. So who's the personality? Who's in control? That's essentially the question that we're answering today. The person in control are the people who have billions of dollars, nay, trillions of dollars. Scratch billions and to replace that with trillions. They have trillions of dollars, and those amounts of money, that amount of money is in control of where the market goes and where the market does not go. So that means that this entire game is rigged. Correct, it's rigged. And I know it's hard to imagine at first, and it's pretty demotivating, but trust me, it's not as bad as it seems, because this is where smart money comes in. Because these hedge funds and institutions and banks know exactly where you're entering, and they know exactly where your money is, aka your stop loss. We have to trade a specific way that's designed to follow the moves of smart money, to follow the moves of the institutions and the hedge funds and the banks. And another term I completely forgot to add is volume. Although it's not really a famous term that's used, but volume slash, let's say, momentum. There we go, volume slash momentum. And that's pretty self-explanatory. Volume momentum is just a lot of volume and momentum in the market. So yes, cool. So now what is smart money? Smart money is basically the belief, or the strategy, not the belief. It's the strat. I've been watching too much Speaker's Corner lately, my bad. But yeah, smart money concepts is the strategy that uses the hints and clues that the market leaves, the market makers leave, aka the banks and the institutions, and we use those hints and clues to lead us to a specific observation that leads us to executing a trade based on those clues and observations. So let's assume I'm a market maker, right? Let's assume that TraqFX is a market maker and he has $1 billion, $1 billion hedge fund. So yeah, let's say, like, you know, the market is going down, this, that, and then I make, and then I do this. I say every single time the market goes up, down, and then up, I'm gonna take a trade. I'm gonna make a buy. I'm gonna make a buy. So I'm a market maker, remember. So I do this. So put my stop loss at the low and then take profit the next high, and then boom, the market goes up and takes me hits my take profit. I make $1 million. Okay, let's say it happens again. It goes down, up, down, and I take a sell. So then I start selling. Now, basically what's going to happen is eventually my strategy, my down, up, down move, my up, down confirmation is going to be exposed the more I use it, right? And a very small minority of people are going to learn that I'm using this, and they're going to use this down, up, down clue that they get to actually enter the move with me. Whilst what the retailers are doing, you know, the support and resistance. And by the way, I have to make this very clear. Support and resistance works. Breaks and retest works. Everything works. It just depends on how you implement it, right? Even smart money concepts, it might not work for you and it might not work for someone else, but it could work for someone else, right? It all depends on how you implement it. So let's say that my strategy down, up, down becomes revealed, and I'm a bank, and then all the retail traders such as myself and other people, they figure out that I use that every time the market goes down and then it goes up and then it goes down, I execute a sell. They're going to understand that clue, and then they're going to use that clue to also catch a sell with me, and vice versa for the buy. So that's literally what smart money concepts is. And all these concepts that the terms that I've mentioned at the beginning of my video, these are the terms, these are the clues that the market maker has left for us to understand. Not for us to understand, sorry, but these are the clues that the market maker has left. And the biggest clue, in my opinion, is, and I can't believe I forgot one more, order block. Yes, order block. There we go. And imbalance. And we're going to go over all these, don't worry. So I think the biggest clue that the market maker leaves is volume and momentum. Everything else is minor, in my opinion. Volume and momentum. So now that we understand the terms and we understand the difference between smart money concepts and retail concepts, we have to understand now, or we have to investigate how it's being used in the markets. How can I use it in the market, right? The first step to doing this is to go from 1 to 10, meaning that we have to start from the basics and go all the way down, work our way down. So we're going to start off with changes of character and breaks of structure. Changes of character and breaks of structure fall under one category, and that category is 2 M's. 1 M and 1 S, market structure, right? Everything has its own category. So changes of character, breaks of structure, and continuation of structure. These fall into one category, and that category is market structure. So the first thing that you as a new trader have to do before you get involved in trading the markets, before you open a broker and deposit your first money, or deposit your first deposit, before you go to your parents and ask them to fund your account, you have to understand what market structure is. Because if you do not understand what market structure is, you're going to have a hard time understanding Wyckoff, which is an advanced version of market structure. And then you're going to have a hard time with order blocks. And a common mistake I've noticed a lot of traders make is they jump the gun to order blocks and imbalance. They jump to the advanced concepts because everyone on YouTube and Instagram, including myself, I'm a part of the problem. They all just go, guys, order block, supply demand, supply, demand, imbalance. It's like we're throwing the word around and we're just passing it like a football, you know? Basically, no, an order block is not a secret tool that's going to make you a millionaire in 4 days. No, it's definitely something extremely important that we need to know and we need to understand, and we need to know how to use it. But what's more important is the basics, because if we don't understand the basics, we're not going to understand the advanced concepts such as order blocks. So what's the first thing that we're going to go over? Before I actually go over market structure, I actually want to show you a quick setup that that was available 2 weeks ago, or not 2 weeks, I think last week actually. Yes, that was available last Sunday, last trading week, and this was using smart money concepts. So I'm gonna provide you two examples. The first example is what the retail trader who uses support and resistance is doing, and then we're gonna provide you the example of what smart money concept traders are doing. The traders who follow the smart money. That's exactly what smart money means. So what a retailer would be doing at this point is, let's actually open up a brand new chart and let's delete all this. So a retailer at this point who trades support and resistance, what they would be doing is they would simply be following the breaks of structure, the continuations of structure, the followings of support and resistance. So we can see that there's a level of resistance right here, and then we can also see that there's a level of support right here. And essentially every time the market reaches this level of support or this level of resistance, I would simply take a buy. It's very that simple. I would simply just take a buy. And if the market comes to support, I buy. If the market comes to resistance, I sell. See, what actually happens is as the market touches these levels of support and resistance, the weaker these levels become. And you can see that at this point, as soon as this candle would have touched my blue support zone, I would have been looking to become a buyer at this market, right? I would be looking to buy at this point. Well, look what happens. The market goes down and it stops you out. This is the exact point the smart money trader is getting involved. Because what is the first thing I told you? The first thing I told you all was that liquidity is money. And smart money does what? It follows wherever the most money is. So that means if 90% of retail traders are buying at this point, and their stop losses are all scattered around the same area, this point right over here, this area, it's like a general area, that means that market makers, i.e. the controllers of price, they're not really the controllers of price. The controllers of price of Allah, of course, God, but the people who created the algorithm, what they're gonna do is they're gonna dump the market towards where the most money is, right? Because your stop loss is money, and this is what liquidity is. When someone says liquidity grab, it essentially means that an abundance of stop losses have been grabbed. And this is exactly what happens. This is a perfect example. So all these traders who were buying at support, they had their stop losses hit. Now, remember, we are not looking to be buyers at this point. We're actually looking to be buyers after price action stops these traders out. This is what smart money is. All right. Instead of giving you a tutorial 101 of what smart money concepts is, why don't I show you an example? Because then you could see from firsthand experience. So right over here, we see that price action has an order block, right? And this order block has not been mitigated yet. For those who don't know what order blocks are, do not worry. We're going to cover this in a different video. It's very simple. And if you want to watch some of my previous videos, I've covered exactly what order blocks are. But this is the clue that the smart money, the market makers, they leave. They leave this as a clue, and we pick up on this. We pick up that clue, and then what we do is we switch to the smaller time frames, right? We go down to the smaller time frames to get a better look. And what was the first thing I told you about market structure? We talked about the terms, the continuations of structures, the breaks of structures. So what we can see is we have a high, and we have a low, and then we have a lower high that created a lower low, and then you have another lower high that created another lower low. Very simple. So we have lower lows, lower highs. And then look what we have. You have the market breaking past these lower lows and lower highs. So if the point of a market selling, if the characteristic of a market that's selling off is to create highs that are lower than the previous highs, but now the market is creating highs that are above the previous highs, meaning this is a high that's lower than this high, and this is a high that's lower than this high. But now the market has created a high that's above this high and a high that's above this high. Then what do we have? We have a break of structure, also known as a change of character. And this is when smart money, and remember, this is another clue of smart money. So this is when we find out as retail traders, as retail traders who trade with very small amounts of money, small amounts of liquidity, this is the clue that we pick up on to understand that the market is now changing. It's changing its character, and the trend is now coming to an end. The previous trend of this downtrend is slowly coming to a stop, and the reversal is coming to a start. That the market is now going to reverse. And this is exactly how smart money traders are catching these huge entries. Now, we move on to the third concept, or sorry, the one of the final concepts, which was volume and momentum. Remember we talked about volume and momentum. It was right over here. Oh, sorry, it's not on this chart, it's on a different chart. But yes, volume is basically just the market's capability of moving in a specific way or direction with mass amounts of orders and huge impulses. As in, let's say I jump once, right? And I only jump this high. It's limited. It's not that impressive. But imagine I jump this high. Like I'm going for that slam dunk. Like I have the ball, third quarter, 10 seconds left. I shoot it. Everyone's saying, Traq, Traq. I shoot the ball, it misses. I go for the layup, miss, and then I go for the dunk. And boom, everyone's screaming. They're like, Traq, Traq. You see, they're all hyped because I jumped so high and I dunked the ball. That's exactly what's happening. Smart money, right? Terrible example, but I'm just messing about. But smart money, what they see is that the market, or what we see as retail traders, is that smart money is most vulnerable when price is near areas of liquidity. And when price mitigates, aka takes all that liquidity, eats your stop loss up, price action reverses in the opposite direction with mass amounts of volume, with mass amounts of orders, with mass amounts of impulse. Why? Well, because this is when smart money is getting involved. Remember, if smart money is getting involved, then you can assume that the moves are going to be huge. And if smart monies are not getting involved, you're going to expect moves like this, like very small, wicky, consolidative moves like this. But in areas where smart money is involved, you can expect huge impulse moves like this. So that's exactly what smart money concepts is. And you could also see that from this point on, we have this retracement back into this point of interest. And then I think, yeah, and then from there, I think the market actually invalidates it later on, if I'm not mistaken. Or maybe it doesn't actually. I don't remember. But anyways, and then you can see that price action, does the same thing again. Retailers, they start buying, they start selling here, and they start buying over here. And what happens? Smart money people get involved below their stop loss, and then price action moves away. So this is exactly what smart money concepts is, and this is the difference between smart money concepts and retail concepts. Now, I have to make a distinction. Sorry, not a distinction. I made a mistake. Not a distinction, but I have to make a comparison and a connection between us and them. First of all, I believe 98 or 95, the number always varies. I heard traders say 99. I heard some traders say 95. I heard other traders say 93. I'll say 100. Why not? At least 100%, obviously I'm just joking, the number is not actually 100, but 98% of traders who trade the Forex markets, I'm assuming they lose. Now the number can vary, the number can go from 91 to 90, but it's in the 90s, that's for sure. Why do they lose? Well, because they're all doing the same thing, and that's the difference. Retail traders who buy support, or who sell resistance and buy support, the reason they're constantly losing is because 90% of people are trading that concept. So if everyone were to stop trading support and resistance and they adapted to another strategy that, for example, was not support and resistance, was rather every time the market makes a large wick like this, we're going to sell. So what would happen is then the market would trigger that liquidity instead. So then the market would see, okay, all the money is there, so let me focus on that. So then I'll grab that money. So it's basically just about whatever strategy is the most common and famous. And do not worry. Don't let this scare you about smart money concepts one day going in its instinct. I don't know how to say the word extinct, because it's not. Or it could, and if it does, we're just going to adapt to the new strategy, right? And that's the whole point of Forex. But the moral of the story is the markets have been here for hundreds of years, and people are still making money off of support and resistance, right? And if people can still make money off of support and resistance, you can definitely make money off of supply, demand, order block, smart money concepts, as long as God wills and you have His permission and you're implementing everything properly. With that being said, thank you so much for watching this video. This was a short, comprehensive, and coherent coherent explanation, easy explanation, hopefully, of what smart money concepts is and how you can use smart money concepts in the market. We're gonna continue this series this week. Actually, so yeah, this is how it's gonna work. I'm gonna break down every single one of these concepts. Let's go back to where the terms were. I think I wrote the terms maybe here. Euro USD. Yes, right here. So we're gonna break down each and every single one of these concepts in separate videos. We're gonna break down every single one of these concepts in separate videos. And by the end of this, you should have a very strong understanding of what exactly smart money is, what exactly breakup structures are, what exactly you need to know and how to know and what to trade and how to trade. And you should, by the end of this series, hopefully have a very good understanding of how the markets move. So with that being said, thank you so much for watching this video. I'll catch you all in the next one. Peace out and stay safe, trade safe. Salam Alaykum.